Welcome students. Today we are discussing on a topic credit creation by commercial banks. This topic is presented by me and Manoranjan Singh, PGT Economics. Let's look at some background. We have known earlier that besides the central bank, commercial banks are also an important source of money supply in the economy. Commercial banks cannot issue currency, but as a supplier of money, commercial banks can create money by way of deposits. We have also known that commercial banks are legally bound to maintain legal reserve ratio. They cannot lend out the entire deposit to the productive sector and have to maintain certain fraction of this deposit with themselves. Cash reserve ratio and statutory liquidity ratio are the two forms of the legal reserve ratio, which is decided and fixed by the Reserve Bank of India. Banks know from historical experience that all depositors do not come to withdraw their deposits simultaneously, and also constant flow of new deposits are always there into the banks. So that means if experience tells that the withdrawals are around 20% of the total deposits, then the banks will keep 20% of deposits as cash reserves. Now let us understand the process by which commercial banks will make credit. Suppose initial or primary deposit in banks is 1000 rupees and the legal reserve ratio is 20%. It means banks are required to keep only 200 rupees as cash reserve and are free to lend 800 rupees. Suppose they lend 800 rupees. Banks do not lend this money by giving amounts in cash. Rather, they open the accounts in the name of borrowers who are free to withdraw the amount whenever they like. Suppose borrowers withdraw the entire amount of 800 rupees for making payments. As all the transactions are routed through the banks, the money spent by the borrowers comes back into the banks in the form of deposit accounts of those who have received the payment. It will increase the demand deposits of the banks by 800 rupees. With new deposits of 800 rupees, banks keep 20% as cash reserves and lend the balance of 640 rupees. Borrowers use these loans for making payments, which again comes back into the accounts of those who have received the payments. This time, banks' deposits rise by 640 rupees. The deposits keep on increasing in each round by 80% of the last round deposits. At the same time, cash reserves also go on increasing, each time by 80% of the last cash reserve. Deposit creation comes to an end when the total cash reserves become equal to the initial deposit. So, banks are able to create total deposits of 5000 rupees with the initial deposit of just 1000 rupees. It means total deposits become 5 times of the initial deposit. 5 times is the value of money multiplier. Money multiplier. Money multiplier is the number of times by which total deposits can increase due to a given change in deposits. It is calculated as money multiplier equals to 1 by legal reserve ratio. Thus, money multiplier is inversely related to legal reserve ratio. Thank you. Have a nice day.